All right, good evening, everybody. This is November 10th market update. This is Anthony Garcia with Traders Ultimate Edge. Let's look at the markets today. They made a interesting move downwards. Now, this morning, right here, is where the CPI data came out. That's the inflation data. Yesterday, the PPI data had come out. It actually looked pretty good. The CPI that came out this morning measures the prices on the consumer's end, and there was a definite inflation uptick, which was a change from last month in October. And the market does not like change. It doesn't really like surprise. So the market sold off a little bit when that happened, but it regained it. We opened up here and we came back up to this yellow line here, which is yesterday's close. And if you're wondering, the white lines here, the yellow lines here, these are daily pivot points. So anyway, came back up to yesterday's close, bounced off of it, and we actually sold. If you took the trade, we sold some call credit spreads there. I called that out in the Discord on zero DTE SPX call credit spreads, which expire worthless. And we also opened put credit spreads down here, which when they got up here, they expired worthless. So, excuse me, not worthless, but we closed them for $5. I'm sorry, we closed them for $5. And so anyway, that's where we day traded a little bit today. And then something really interesting happened right here, right at 11 o'clock. At 11 o'clock, we had the 30-year bond auction, which happened. Now, prior to this, the market had just kind of slowly made its way back down to the open, not really doing much of anything. It looked like it was just going to be kind of a choppy day, sit in a range, which is right about what I thought it was going to do. Then when that bond auction came out, things kind of changed. I'm going to show you what happened at the auction. So this right here, this is the auction. This is the 30-year government bond yields. This is US 30Y on TradingView, and you can take a look at the yields. Now, when yields spike and they go up, that means there are less people looking to buy the bonds. So they have to make the yields go up in order to sell the bonds, right? To make them more attractive to investors. So it spiked up for about a minute when we had the results of the auction come out, and then it proceeded to move back down, all the way back down, almost to where it was before the spike happened. Okay, now it's back down here. And we can look, there was a corresponding jump here on the 10-year as well. Right when this happened at 11 o'clock, it spiked up and then immediately sold back down. And a little jump back up here at the end of the day, but it's just back down in this range, in this gap. So when we had these jumps in yields, that normally signals something bad is going to happen to the markets. And that is because as yields rise for bonds, they typically compete with the market for investor dollars. They kind of get into a competition. Higher yield bonds, treasury securities are considered to be the 100% safe investment. So if you can get 2% under 30 years versus an average of 10% per year in the S&P 500, then you have more people stepping out to grab those bonds than were before. So it's believed that the markets will fall. All right. Now, in reality, yes, this happens, but eventually the markets and the bonds kind of find an equilibrium. So it doesn't last forever, but you will usually see those kind of inverse moves when you look at a correlation of bond yields and the market itself. So right here at 11 o'clock, when the yields popped after the Treasury information came out, we'll zoom in a little bit. Right here, and I'm sorry, I'm using Mountain Standard Time, so that's actually 1 p.m. Eastern. But nonetheless, right here, we can see, right here was where the info came out, okay? And over the next 1, 2, 3, 4 minutes, we had a whole lot of contracts traded. This is, again, the ES futures. Okay, so we had 6,500 contracts, 8,500, 9,500, and then finally 13,000 contracts right here were all traded within this 4-minute time span. What I think this was algorithm selling. I think this was probably computer algos that saw the big spike in yields, expected the inverse correlation in the stock markets, and started to sell off right here. That's what I think that was, and I think the algos finished right here. I think that's all it was. I think they finished down in this area, this 4650s area. So that's kind of what I see that happened. And what happened the rest of the day was people. The rest of the day was people selling. You'll see there were a couple volume spikes throughout the rest of the day here until we get down to the bottom. And I'll show you guys this. What happened here at the bottom. I stepped back in with SPY calls here at the end. I think I got them here somewhere. The rest of the day, so like I say, this was all just people selling off. Came down here to the bottom, and then this bumped right into, I don't have it on this chart. Let's see, 4625. Sorry, this chart is super messy. I know what it's saying, but you may not know what it's saying. It came right down here, down into the support 3 area for the pivot points. If you know what pivot points are, then that'll make sense to you. If you don't, then don't worry about it. Nonetheless, it came right down into this area and it did this interesting little double bottom. See it better over here. You see it came down into here, bounced back up on this heavy volume spike. See that? Bounced back up, double bottomed with a higher bottom, and right up over here is where I went long with calls on the SPY. I bought February calls at 464 strike, and I'm firmly intending on holding these as long as it takes to get back up to about 470, and I think it will. And those will print pretty nice for me. Here at the end of the day, let's look at the end of the day. The last 10 minutes are usually pretty telling on a day like this. So we had from about here, we had this big spike up in the price, came up, went back down. Well, we can actually see it fell down here and it came all the way back up. And then it fell down right into the close. This sort of a spike up like this, I would have to think was a lot of short people with short positions recovering at the end of the day. I wanted to see more though. I wanted to see it pull back up into at least this 4650 range, and it didn't. We did still get a nice spike at the end of the day, so I'm hoping that was a lot of funds covering their short positions. But we'll have to see what tomorrow brings. Now, like I say, a lot of this sell-off was precipitated by the bonds, and the bond yields jumped because inflation. Because inflation rose in the CPI report, and it's going to rise. When inflation rises, less people want bonds because the returns of the bonds will be so much less than the inflation rate, right? So it makes bonds less attractive. So therefore, the bond yields have to rise in order to get more buyers, and it's pretty convoluted. But nonetheless, inflation is, in my opinion, going to rise through December. That's because we have more people out and about after COVID, and they're buying things, they're using services, and we have a similar kind of like a bit of a labor shortage. I mean, it's not a shortage, it's just less people were in the markets, although we did have really good job numbers previously. As long as we continue getting really good job numbers, that will help the labor issue. But as companies were struggling to find people, they were paying higher wages, they were paying bonuses. Higher wages and bonuses are also inflationary. So we have that. We also have supply chain issues causing increases in prices and everything. Well, virtually everything. Supply chain issues are causing that. So we have a lot of factors pushing for inflation. I do believe it's going to continue through December. So there's absolutely a trade in gold, by the way. Absolutely a trade in gold. We talked about that a little bit on some of our calls. We'll talk about it again tonight for our clients. You will have a trade in gold. Wait for a pullback. Wait for it to get back down to a nice entry point. And then I think you'll have a long trade in gold, because the numbers for next month are going to show more inflation because of the reasons I just stated. Now, after December, I believe that's when inflation will cool. And I believe that's when the Fed's, the Fed, they talked about inflation being transitory. I think that's when that's really going to come to fruition. And we're going to start to see that in the Q1 of next year. And also keep in mind this pullback here today. Keep this in mind, all right? And let's zoom out just a little bit. This is the last thing for this video. Okay, here was Fed announcement. It went right back to these highs on Fed announcement day, okay? When the FOMC came out with their incredibly dovish statements and Powell's incredibly dovish speech, they specifically said in that statement, and you can go back and read this, that they were okay with inflation running hot because it had been so low for so long, and their goal is a 2% average over time. They are okay with it running hot. So they're not going to increase interest rates. And that's what the big concern is with inflation, is that the FOMC is going to step in and increase interest rates. Okay? They've already stated they are going to remain very accommodative for the recovery, and that they don't mind that inflation's running hot. My personal opinion, I think this pullback was it was a big overreaction, and I think getting long down here is fine, especially with February dated calls. Tomorrow, if we're still in the same area, you could probably get long the same, and granted, it may take a little while, but I think you'll get some nice profits off of them. So anyway, that's my thoughts and feelings about the market today. If you have any questions, feel free to drop it in the comments. And as always, have a nice evening, and I hope you make a bunch of money tomorrow. Take care.